Sylvia Jablonski, Managing Director of Capital Markets at Direxion. She has great ETF picks in many of the different sectors. But first, Sylvia, I wanted to get your overall market feeling as we hit new highs today. We're kicking off a new year. Your thoughts?
Yeah, happy New Year, Nicole. So I think that 2020 is setting up to look like a pretty good year. So December was one of the best years for equities in about 50 years or so. Everything sort of went right, minus the volatility of the uncertainty around China. We had supportive central banks globally. The Fed remained solid. The Fed remained supportive of the markets. Earnings were good. They were pretty much in line. We had a good amount of companies beat throughout the year. And really just about every sector performed. So I think coming into 2020, we're starting off with a similar backdrop. The recession seems a little bit further out. The jobs numbers have been pretty good. Consumers are spending. Companies are expected to continue growing a little bit. And I think that, as far as returns go, investors and retail investors want to buy equities and stocks, and that should sustain the market for at least the first half of the year.
It almost feels like a can't miss market, right? I mean, you're saying how just about everything went up, and that really is true other than energy. You almost couldn't miss. Right. You shot an arrow. You sort of almost hit anything that was a winner if you did a big sort of investment as opposed to an individual stock per se. Gold is something that was on your radar. Even that you said may come into favor. I mean, we've seen gold rushing up recently. A quick gold thought before we get to your picks.
Yeah, the quick gold thought, and I think it's an overall commodities thought. Looking at those types of products. I think what's interesting there is you saw it play out with Iran tensions right away. Investors flee to safety and they pick up things like gold. But it's also an election year. So we expect to see some volatility in the markets this year, regardless of what your outlook is. I think most analysts on the street are sort of in consensus about that. And gold is really the safe haven play. So I think investors look to add some of that into their portfolios.
Yeah. So as you see stability and the support at home from the Federal Reserve, the central banks around the world, you have some picks in different areas, including consumer discretionary. Tell us about that.
So the consumer makes up about 70% of the economy right now, and the consumer has been employed. The Fed has put money back into the pockets of businesses, and the businesses have put money back into the pockets of their employees. So consumers are spending their wages. We saw that with the cyber sales numbers. They were essentially up and far exceeded expectations, and a lot of consumers simply put their money to play. So I think that that will likely continue into the new year. I think the only thing that sets that back is sort of like self-imposed fear about geopolitics or China or perhaps a flip-flop from the election. But I think the consumer is healthy, strong, and spending.
So WANT is the ticker symbol of the ETF then?
WANT is the ticker symbol.
Right.
One of the biggest names in that index is Amazon. Continues to grow, touches just about everything. It's just been an epic growth story for the decades. And I know that there's sort of some scrutiny and regulatory concerns there, but the consumer continues to go digital, disruptive, high tech, and Amazon is there.
And then the China story, you have said if you want some China exposure, not a bad idea, right? I saw you have yin and yang and CHAD, and CHAU would be another one. You have several ETFs that give you China exposure. You think that's a good idea?
I do think that's a good idea for various reasons. So you have China, which is an ETF like yin, where you get the broad H-share exposure. You have CHAO, which is A-share, and CWEB, which is China tech. So all of these stories are lined up to play out well. China tech, because China is the #1 adopter of robotics and AI right now. They're a big tech spender. They have the fastest growing middle class retail community, and they're spending on technology, disruptive technology. A-shares, because they're simply opening up all the markets and they're being included in the MSCI indices, so they're likely to get a pop from that. And also just stimulative policy from PBOC, injecting liquidity into the markets.
Right, which they've been doing.
Absolutely.
You don't fight the Fed and you don't fight the People's Bank of China.
Exactly.
Right?
Exactly.
You mentioned, I'm going to jump ahead to the robotics name, UBOT, because you started talking about the Chinese exposure to that, and here at home we have that as well. But this particular ETF is 3 times, right? Some of these are 3 times, so people should understand if it drops, you're losing 3 times your money, but if it gains, you're gaining 3 times, right? So tell us about UBOT. This is AI and robotics.
So it's 3x AI and robotics, and it tracks the index on a daily basis. So it's 3x the daily performance, not over a long period of time. but investors can hold it for a longer period of time if they feel that the market is trending. Volatility will not be range bound. Essentially, trend is your friend with these ETFs. So
is this something you would pick up and hold on to for many years because you think AI and robotics is something that will do well for the entire decade?
Well, so I think you have to have a very precise opinion on volatility. If AI and robotics just trended straight up for a year, you would do extremely well. If, however, you had range-bound volatility, you wouldn't have the same type of result. You could, in fact, be down even if the index ended up. So the key is you have to have a specific opinion on time frame and volatility and the direction of the index. But in general,
so you have to watch these very closely.
You have to watch them very closely. But the AI story, the robotic story, is just there. You know, again, disruptive technology. You have technology in touching every sector: healthcare, retail. You know, automating robots to increase PMI in countries like Japan and Europe. We're just at the beginning of 5G. All of these things are poised to grow, and that's what you get from AI.
Do you recommend one of these over all the rest? I mean, as far as sectors, I mean, I know you have biotech and healthcare here with LabVIEW and LabD and Cure and Pills and many different ETFs that are available. As far as these sectors, these 5 go, is there more hope for some over the others?
You know, I think emerging markets is poised to see something come to fruition this year. You know, it sort of has the right demographics: young, educated workers, investment in technology, GDP poised to be 5 to 6%. It looks like we're getting some sort of settlement or trade deal coming to fruition. At least phase 1 is, January 15th, and then who knows? You know, it's an election year. Hopefully, phase 2 it sounds a little bit better to get more performance there. But I do think that emerging markets are essentially poised to grow. The U.S. is still a great place to be, but you just have to spot check. Valuations are high. Emerging markets, Europe, developed markets have been absolutely crushed. And these are opportunities to get in low and ride that out.
Yeah. All right, so we'll watch for all of that. It's an exciting year already, I think.
It is. It definitely is.
As far as the markets go, so it's a lot to watch. Sylvia, it's great to see you.
Thank you
Sylvia
for having
Jablonski, Managing Director of Capital Markets at Direxion, for joining us here on the show. We're glad she was here.